Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. So, we just went through quite a week. For reasons obvious to everyone in these plays, the vibe and confidence seem to be at a low right now. Ryan Cohen, SuperStock's glorious spiritual and financial savior, filed statements to sell out of his investment in Bed Bath & Beyond. This came as a shocker to most, and many are feeling betrayed. The man, who is heralded on a daily basis as the champion of investors, the one who doesn't sell, the big ape holder who resembles everything we should aspire to be as meme investors, sold. What compounds this issue to many is that a notable amount of meme investors were holding Bed Bath & Beyond solely because Ryan Cohen was holding positions there. Because he sold at a great price, the stock ended up plummeting, with all those faithful investors now holding significant losses and bags after Ryan Cohen effectively transferring their money into his own pockets in a way. Now, I cannot count how many people I have read said they feel uncertain about their investments, unsure Ryan Cohen would even hold GameStop into the future as the possibility of him selling has increased in the eyes of meme stock investors. I even saw some posts reach the top of SuperStock most upvoted for the day saying how they are scared but continue to hold. The frustrations held there have also made their way into AMC. Though most people plan to hold their new ape shares, there are also some that have said they fear future dilution and what Adam Aron might do with them. To this end, we can summarize the general state of mind of meme investors as being uncertain, and we shouldn't shy away from talking about it. The reality of being a meme investor is that indeed this is a very risky play where we rely on each other, strangers, to hold for the collective well-being of everyone. One of my biggest pet peeves with the movement has always been the reliance on needing celebrities to idolize. The problem with this is that the mistakes, the decisions of these individuals will oftentimes have direct impact on how we feel about our own investments. We came into GameStop and AMC not because Ryan Cohen or media personality, but rather the people holding and the intent behind that investment. We might have been introduced by some YouTuber into the play, but we stayed for the analysis made in the faith in the community. Once we depart from that and start looking into someone to lead and place our confidence in, their shortcomings will inevitably create doubt and chaos at times. Their faults will be accentuated in droves of people feeling sad and unsure. This is why it is imperial that we stay zen throughout the entire process. Yeah, it's nice and fun to follow these so-called celebrities, but in the end, the collective bunch of retail investors and sheer determination to buy as much of the float as possible is what will make us last. I said long time ago that this play will have much less victors than people assume. Hedge funds' only play is to have retail investors exit by making the play as long, boring and unpredictable as possible, which causes people to paper hand. That is exactly what has been happening. That's why I always tell people, don't go full YOLO on GameStop or AMC. Instead, find comfort by adding to your investments at a pace and reasonable way. This play can take years to pay off, and that's the reality that most people are unwilling to accept even now, almost 2 years into this. Balance is the only thing in this play that will grant you the longevity, the peace of mind and the ability to hold strong, nothing else. Bed Bath & Beyond was a great play for those that sold at the top. It is important to always collect winnings and not just hold onto stocks with the assumption everything will continue going up. Unless it's an investment, such as GameStop or AMC, which are the strongest meme plays right now, there is no reason to hold through a squeeze like that endlessly. Many assume to know what people like Ryan Cohen plan to do, and this was a reality check that nobody knows anything at all. When it comes to these lesser popular meme stocks or any other play, make sure to always have an exit plan. Remain humble at all times and don't listen to anyone assuming to know what others will do or where these plays will go next. Investing in meme stocks is like being blindfolded and told to find our way out of a labyrinth. We know that eventually in an infinite timeline scale, we come out, but our way out is going to be filled with more uncertainty than we currently would like to acknowledge. Now, I want to talk about markets and what to expect this week. Last week we saw equity markets weaken. The Fed made statements suggesting that they are committed to tighter monetary policy, and it has led to a general pullback. We saw further deterioration of Chinese economy as well, something we have been covering for months. This week, we have earning reports from a wide range of companies across multiple sectors, along with some important economic data releases that ought to foreshadow where we might head down a couple months from now. Beginning on Monday, we have earnings from Zoom, Nordson and Palo Alto Networks. Tuesday, we have earnings from Intuit, Macy's, Nordstrom, as well as getting the S&P Global Composite flash estimate. We should also see new home sales for the monthly of July. On Wednesday, we have earnings report from Nvidia, Salesforce and Petco, as well as get pending home sales for the month of July. Thursday, we have earnings from TD Bank, Dell and Gap. We will have access to the US GDP growth rate's second estimate for the second quarter of this year. On Friday, we have personal income and spending data for the month of July. On Thursday and Friday, we will have what is called the annual Jackson Hole Symposium, where the nation's top central bank officials will come together. Many are expecting or wishing Fed Chair Jerome Powell to reset expectations in the financial markets. Powell is due to speak at 10 a.m. Washington time and is expected to restate the Fed's resolve to keep raising interest rates in order to get control of inflation. Whatever comments Powell make will have a direct impact on the economy and on the stock market, so expect the potential for great volatility on Thursday and Friday. Lastly, I want to talk about China, because there has been a wide variety of events and reports coming out that suggest further decline in the economic state of the country. Today I am going to focus on talking about employment in China. Remember that the economy of a country is embedded in different sectors. We have hyper-focused on the real estate sector of China, but this week, I plan on making episodic segments covering a wide array of them through each day of the week. Beginning with the one that has been making rounds, Chinese college graduates seems to be having a huge problem finding employment. As reported by Barron's, young people in China can't find work, and the unemployment rate for those aged between 16 and 24 reached a new high on July. The official rate came in around 19.9%, meaning 1 in 5 young people are unemployed. Employment overall did go down as well, however, but the figures released do not account for migrant workers who have moved to China, so the real numbers are much bigger than the 5.4% that was released by the government. Interestingly enough, it is university graduates that are finding the biggest challenges finding employment. More students graduated this year than at any other point in Chinese history, making for the largest job market ever, but graduates can't find desired jobs. These types of problems often work in conjunction with others, as you will now see. China has been adhering to certain zero-tolerance pandemic policies that have crushed economic activities in areas, even if the outbreaks are tiny. As you know, the property crisis, led by Evergrande, has had monumental impacts in restraining Chinese economic performance, especially when the Chinese government refuses to stimulate the economy themselves, which is leading the country to close its 2022 gross domestic product target to be around 5% growth. All of these things have affected the consumption in China and hurt its businesses, but it is especially the lack of income for the youth that is affecting it the most. When you combine unemployment and poorly performing property markets, it hits consumer confidence. Add that the pandemic overreactions by the government and you have an economy barely holding itself together. Their consumer confidence tends to bounce back quicker than American counterparts, but so far it has remained bottomed with no sign of bouncing up. This will likely remain to be the same until significant progress is seen. Now, another significant contributor to the decline of employment for youth is that tech companies remain skeptical about the future. China has been cracked down hard with extreme regulation, putting these companies on edge. As such, growth has been extremely affected, and that has led to a lot of corporations to withstand from expanding and hiring more people. The problem with this is becoming so serious that now we are seeing firms considering moving their operations out of China completely. Even Apple is considering manufacturing MacBooks and Apple Watches in Vietnam for the first time. These problems are exhausting the morale of the youth, and we will continue to weight Chinese economy down. Like I said, I plan on making more Chinese economy related videos this week, so make sure to tune in. This week will be really interesting, in particular for AMC investors, as we are bound to receive our APE shares, which should be made available to us finally. We saw the world's second biggest theater chain Cineworld file for bankruptcy 2 days ago after it was unable to recover or remain profitable. The pandemic woes certainly made it impossible for the theater chain to bounce back, and given that AMC received all the attention, Cineworld's days were numbered from the get-go. I have seen many people say that Adam Aron and AMC should step in and buy them. I think this would be a wrong move. I think AMC could certainly benefit from acquiring the best locations that receive the most traffic, as that could help bolster revenue streams, but it shouldn't come out and buy them outright. AMC is certainly in a much better position, but it still has to deal with large amounts of debt as well. I want to see how APE performs and how AMC overall performs as well. I think there is room for opportunity for AMC to acquire the best locations and perhaps take some of the best talent at Cineworld, but that's about it in terms of what I think AMC should look to gain from their downfall. The consolidation of theater chains in the industry can literally only help AMC in the end, so as mean as this may sound, this is a good thing for us. Sorry I did not make many videos this past week. My computer was malfunctioning and I had to get it repaired, which took longer than I expected. This week you can expect daily content from me as we cover all the events taking place regarding GameStop, AMC and the worldwide economy. Come over to my Discord and check it out. Other than that, I hope to see you tomorrow. Enjoy the rest of your day and to the moon.